Hey guys, the Healthy Investor here. Today, I will show you how to get most or even all of your tax back using real estate. Take Tom. He has little work expenses and no real estate. He earns $50,000 a year and pays $9,000 in tax, therefore taking home $41,000 gross. Every year at tax time, he claims $500 from car expenses for random trips out of the office and $100 for the cost of doing last year's tax return by an accountant. Tom will get little to nothing back from his tax return. Unfortunately, this is the case for most workers. Now let's have a look at Jerry. Jerry earns the same $50,000 a year, paying $9,000 in tax and takes home $41,000. Jerry, however, invested in 2 apartments early on, rents them out for around $580 a week, and also contributes repayments out of his own income. At tax time, Jerry claims the same $500 in car expenses, but also claims expenses on both his properties in the form of the bank's mortgage interest, borrowing expenses, strata payments, water and gas bills, council rates, repairs and maintenance, insurance, agent management fees, capital works, and depreciation. That's quite a long list of deductions, most of which Jerry has had to fork out of his rental income. But the last 2 deductions, capital works and depreciation, is where Jerry gets most of the upper hand. See, those deductions are counted as legitimate expenses, but is not a cost that Jerry has actually incurred as an expense during the year. Rather, it is built in as depreciation in the value of the building and its fittings itself. But realistically, as we all know, real estate does not depreciate in value over time, but almost always does the opposite. So Jerry can leverage this strategy to maximize the expense claim and get a big tax refund. Let's calculate how much he can get back. We have his regular income of $50,000, of which he already paid $9,000 in tax. We also need to include the rental income he receives from both his properties of $30,000 each, of which he has paid no tax yet. In terms of expenses to claim as deductions, Jerry has the same $500 car expense and $100 cost of doing last year's tax returns as Tom's expenses. In addition, Jerry's investment expenditure also includes $16,000 in mortgage interest, $4,000 in strata payments, $1,500 in agent management fees, which works out to be about 5% of the rent, $900 in water and gas utility bills, $800 in council rates, $400 in landlord insurance, $18,000 for combined capital works and depreciation in the first year using diminishing value method. And let's allow $1,000 in repairs and cleaning per year on average. Since Jerry has 2 properties, let's multiply this total by 2 for simplicity. And then add on a $395 borrowing expense, which can actually cover both properties. So even though Jerry's income has increased to $110,000, his expenses to claim as deductions has also increased greatly to $86,195, giving him a total taxable income of $26,805 for the year. This means that his tax bill is only $2,000. Since Jerry has already paid $9,000 through income tax, he will receive $7,000 in tax refunds through the mail. If Jerry had a 3rd property, he would have received all of his $9,000 tax back. But that would not be efficient, as it only nets him the extra $2,000. The most efficient income for the 3rd property, using our numbers in order to pay no tax, would be $57,000 per annum. 4th property at $69,600 per annum, and 5th property at $82,200 per annum. Whilst that number of properties is getting unattainable for the average level of income, it is still the primary method that the super wealthy use in order to reduce their tax bills, and is more effective the higher your income. This method is called negative gearing and should be among the plethora of financial strategies in your repertoire. If this video was helpful, please consider subscribing to be notified of more ways to healthy investing towards financial freedom.